Hello class, and welcome back to the Simply Tax School. Today, we'll continue our Back to Tax Reform series by hearing insights on applying the provisions of the Tax Cuts and Jobs Act to the construction and real estate industry.
The question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax.
Hello and welcome to the 5th episode of our Back to Tax Reform series on Simply Tax. So far in the series, we've covered insights from manufacturers and distributors, talked tax-exempt organizations, taken a closer look at the international provisions of tax reform, and surveyed the state and local landscape after the Tax Cuts and Jobs Act. Our guest today is Jason Grosh, a director in BKD's construction and real estate practice in Madison, Wisconsin, who will dig in on the insights in this space. Yeah, that pun was intended. Let's get started building our knowledge with key TCJA changes for the construction real estate industry and get back to class.
So I would say one of the most significant changes relates to the accounting methods that are available to contractors under pre-tax reform law. Generally speaking, for all long-term contracts, for tax purposes, that means contracts started in 1 year and completed in another tax year. A contractor is required to use percentage of completion method accounting, which I'll refer to as POC method accounting, on those contracts if the contractor had more than $10 million of average gross receipts for the prior 3 tax years. So with the passage of the Tax Cuts and Jobs Act, which we all refer to as TCJA here,
I'm going to jump in here real quick and chime in on a little debate that's been going on in the tax community after tax reform, and that's how do you pronounce the name? As Jason just said, like many tax practitioners, we've come to affectionately refer to the Tax Cuts and Jobs Act as the TCJA here on the podcast. But I should point out that some prefer to refer to it as the TCJA. Perhaps I'm just better at numbers than letters and spelling, but overall, it's probably worth mentioning that technically, we're all wrong, since the catchy TCJA name was removed and replaced with the Act to provide for the reconciliation pursuant to Titles 2 and 5 of the concurrent resolution on the budget for fiscal year 2018. Yeah, that's right. It's a mouthful. All right, let's get back to TCJA-fying our minds with Jason.
this $10 million threshold has been increased to $25 million and will be indexed for inflation. So percentage of completion method accounting for long-term contracts generally does not provide for as many tax deferral opportunities as other methods such as completed contract, cash, or accrual. So it's a big deal if contractors can get out of the POC reporting requirement. One thing I would like to note about it, if the $10 million threshold had been indexed for inflation since it was originally instated back in 1986, this threshold would be significantly higher than the $25 million provided for by TCJA. So it's good to see that TCJA included the indexing mechanism to keep the threshold increasing in the future. One other thing to note, with this threshold, the taxpayers are still required to include receipts of certain related businesses that have common ownership with the taxpayer in the calculation of average gross receipts. But keeping that in mind, for a calendar year contractor with no related businesses, percentage of completion reporting would not be required for long-term contracts entered into after 2017 that are expected to be completed within 2 years if the company's average gross receipts for 2015 through the 2017 tax years is $25 million or less. One other thing with passage of TCJA, under the cash method before TCJA, certain corporations and partnerships with corporate partners were prohibited from using cash basis if the average gross receipts were $5 million or less, and TCJA has increased this threshold to $25 million for tax years beginning after December 31st, 2017. And TCJA made some pretty good improvements here for contractors, pretty beneficial changes, but it did not eliminate the requirement that taxpayers use the percentage of completion method for long-term contracts for AMT purposes. However, TCJA completely eliminated the AMT for C corporations and significantly reduced the likelihood that AMT will apply to many individuals. So as a result, the AMT adjustment on exempt contracts may not be nearly as significant as it was prior to TCJA. And TCJA had no impact on the ability of contractors to exempt from POC reporting any of their home construction contracts. So that's regardless of the size of the contractor, not required to use POC reporting for either regular tax or AMT purposes. So that's one of the big takeaways with passage of TCJA. Made significant changes that impact the accounting method paradigm for contractors. So I'd recommend contractors revisit previously implemented tax saving strategies to determine which accounting methods make the most sense in the TCJA environment.
So have you been seeing many people doing that, just like you said, reevaluating those methods and revisiting them now that we've had this big change?
Oh, absolutely. We'll touch base on that a little bit later on, some of the other comments that I had for, when we're getting into year-end planning. But I wanted to touch base on the pass-through deduction too. I'd be remiss if I didn't mention, the biggest takeaways from the tax overhaul in this first filing season. As I've listened to your Simply Tax podcast here, this 199A deduction was a huge change to the tax law, and it is significantly benefiting contractors as well. And even, dedicated entire podcast to the subject, so I won't go into a ton of detail, but wanted to mention a few things on it as it relates to contractors.
Can anyone name the episodes of the Simply Tax podcast that focus on the 20% of qualified business income deduction under Section 199 Cap A? Anyone? Episodes 8, 16, 35, 37, 43, 46, and 54. Back to you, Mr. Grosh.
With passage of TCJA, it eliminated the domestic production activity deduction, which is what contractors were using in the past, and in essence get a 9% deduction on their construction income. So in its place, TCJA provides for the 20% pass-through deduction on construction-related income that pass-through contractors should largely be eligible for. And as the individual top rate has also been reduced from 39.6% to 37%, contractors operating as pass-throughs generally are seeing a significant reduction in the federal income taxes, as they are going from paying tax on 91% of their construction income at a 39.6% rate. Now, we're talking about high income taxpayers here. So an effective rate of about 36% federal to 80% of income taxed at a 37% rate, or about 29.6%. So the overall effective rate has been reduced from 36% to 29.6%, which is over a 6% rate reduction. Now, this doesn't factor in the potentially significant federal tax benefit the contractor was previously receiving for the state income tax deduction under pre-TCJA rules that they'll no longer be entitled to post-TCJA due to the cap on the itemized deduction for state and local taxes, which is commonly referred to as the SALT cap. In that same vein, some states have attempted, and successfully, some not so successfully, to remedy the SALT cap limitation through various means. And for example, here in Wisconsin, where I'm located, Wisconsin passed a law effective for 2018 for S corporations that allows S corporations to elect to pay the Wisconsin state tax owed on the S corporation income at the entity level to avoid having to pay the Wisconsin tax at the individual level and not being able to deduct it on their federal income tax return due to the SALT cap. There are some limitations to the election, so some additional analysis needs to be done, but it can provide significant benefit to pass-through contractors if the facts are right. So this election will be available to pass-throughs, taxes, partnerships in 2019 here in Wisconsin. And I know Connecticut's made a similar change to their taxing regime. They made it mandatory, not elective. So states are definitely looking into these SALT cap workarounds. A lot of moving parts here, but especially in lower tax states or those states that have adopted effective workarounds to the SALT cap, contractors operating as pass-throughs are realizing significant tax savings with the switch from the DPAD to the 20% pass-through deduction. And one caveat to that, there's this potential limitation of the 20% deduction based on W-2 wages. So contractors need to keep that in mind, ensure their 20% deduction isn't unnecessarily limited by the use of subcontractors versus employees. And for C corporations, it's a little easier analysis. There's no pass-through deduction for the C corps, but there was a significant rate reduction to 21% from the 35% maximum. That provides some substantial tax savings to the high-income contractors operating as C corps as well.
Talking about some of the challenges with it, obviously as well, have been the fact that being that we've got these new provisions, we don't necessarily have guidance around a lot of them. Some of them we still don't have guidance, right? Obviously, like an example, the excess business loss limitation. That's one that can, I would imagine, hit some of your contractor clients. Just kind of the ebbs and flows of business and the way it works, and you end up with a loss and it gets limited and you carry it forward. But we don't really even know how that works as of yet. So how has that been for you with the kind of the lack of guidance or, the guidance that has come out and applying that for you and your clients?
Well, luckily for me, I haven't had to deal with that excess business loss limitation or the net operating loss provisions yet. The contractors are doing pretty good right now. So knock on wood, hopefully that keeps up and we don't ever have to figure out this excess business loss limitation. But in terms of the guidance, I think one of the things we're really lacking is kind of what constitutes a qualifying business for 199A purpose. And I think the IRS has done a reasonably good job of getting guidance out, considering the amount of changes that were made to the tax law. But they're still playing catch up, I think, without a doubt. So, for example, there's not a lot of guidance out there as to what constitutes a consulting activity and is therefore potentially ineligible for the 20% deduction under Section 199 Cap A. So more definitive guidance in that area would be appreciated, illustrating what constitutes a good or bad fact pattern for purposes of determining if, say, construction management activities are a specified service, trade, or business, and therefore potentially not eligible for the 20% deduction. One other, wrinkle to this new tax law with this non-deductible parking issue and how to allocate expenses needs to be addressed. For example, does on-job site parking need to be accounted for under these rules? Probably not, but it'd be good to get some more guidance on it. And more guidance should be issued as to what to do in lease situations or provide a safe harbor method for taxpayers that don't have the accounting infrastructure set up to track expenses associated with the parking lot. Unfortunately, IRS has just about provided zero guidance on how to determine how to allocate expenses between the building and the parking lot. So you're stuck with using a reasonable method for allocating them and then determining non-deductible amount.
Yeah, no, that's a challenging calculation and one that's more involved than I think a lot of people realize. And I think it impacts rather a lot more people than I'll say even I initially realized. A common question I've been getting, again, kind of now that we've had some time to start to apply these things, obviously there's still returns that are on extension until September or October, but having that perspective now, maybe what are some things to do prospectively from a planning perspective, particularly as you get into this year that can be done or that maybe you're discussing with your clients and the taxpayers that you work with?
There's some additional tax planning opportunities contractors still need to be looking into. There's this overall accounting method, really beneficial, generally speaking, for subcontractors, which is the accrual excluding retainage accounting method. And it's an overall accounting method that allows a contractor to exclude retainage receivables from taxable income on jobs started and completed in the same year. Retainage payables on these jobs may not be deducted until paid. But with subcontractors, the retainage payable amounts are generally small. In the case of a growing contractor with a lot of retainage receivable here on these jobs that are started and completed in the same year, this can result effectively in permanent tax savings. I implemented this accounting method change and seen subcontractors defer over $1 million of taxable income by switching to this method. And the beautiful thing about it is it's an automatic method change that can be implemented retroactively. So That means the taxpayer can decide whether or not to make the change for a particular tax year after the tax year is ended, file the Form 3115 application for change in accounting method, and attach it to its timely filed return, including extensions. So that's particular. That could be a home run, something that especially subcontractors would want to be looking at. For those contracts that are still subject to POC reporting even after the passage of TCJA, for these larger contractors, TCJA did not impact the ability to use some of these long-term accounting methods that can result in significant tax deferral opportunities. One that I'd like to touch on is a little bit is the percentage completion excluding subcontractor payables in pay if paid states. So in states where there is no legal obligation to pay subcontractors, meaning states that enforce pay if paid clauses that have been written into construction contracts, a contractor is not required to include payables to subcontractors in the POC numerator. As that's the case, utilization of that method can result in tremendous tax deferral opportunities, especially for general contractors. So that's one we're always looking at. It just depends if they, if the contractors operate in one of these states and they are able to use these contracts with these written provisions in them, it can be a significant benefit. Another method to consider utilizing, especially in light of the taxpayer-friendly changes made to the AMT with the passage of TCJA, is the percentage of completion capitalized cost method for residential construction contracts. And this allows for 30% of a contract to be reported on the contractor's exempt method, such as completed contract, and the other 70% of the contract must be reported on percentage of completion method. So examples of projects that may qualify as residential contracts include apartment buildings, nursing homes, assisted living facilities, prisons, dormitories, and barracks. So it's basically buildings containing more than 4 dwelling units. So contractors utilizing this method need to report 100% of the contract on the POC method for AMT purposes. But again, there's been some very taxpayer-friendly changes made to the AMT, so this is probably not nearly as much of a drawback as it used to be pre-TCJA to utilizing this method. A couple other opportunities that I'm always looking for on my contractor clients there's election that can be made to defer including income on contracts less than 10% complete, and then accounting method to exclude retainage payables from the numerator in the percentage of completion fraction. So those are some big picture items to still be looking at. After TCJA can result in some significant tax savings, even in this new tax environment. It doesn't, and this goes back to what we were saying, where you need a big picture approach. Though this doesn't address state conformity with TCJA. It's safe to say that not all states are conforming with TCJA or with the Internal Revenue Code in general. So,
Class, you can learn more about the state and local tax landscape after the TCJA with episode 73 of the podcast. Take it away, Mr. Grosh.
Keeping that in mind, I've gone through year-end tax plan with some of our clients, and in some instances, what looks to be like home runs from the federal income tax perspective, they were, equally or more so burdensome from a state income tax perspective. So, need to take a holistic approach to tax plan when considering implementing these changes that we're discussing here.
What would you say if you're a contractor that maybe hasn't had those conversations yet? Everybody's got a lot on their plates right now, but what are ways that if they're they haven't had some of these conversations, they can initiate them? Is it maybe some education they can do, or who they should be talking to? What's your recommendation if someone feels like they haven't quite taken this deep dive yet on kind of revisiting after filing for 2018?
Well, obviously, we're more than happy to help out. It becomes easier for us to do so if they have good contract schedule, clean contract schedule, a lot easier to implement these strategies and to kind of determine what the impact would be if the contractor has good books and records and a contract schedule.
For sure, and that hits on maybe a good point of some of these things, like even when we're talking about meals, entertainment, and the parking and all of that, books and records, right? Is a key part of this is understanding the facts and this what's happening in the business and tracking that differently. Are there things that you would say maybe just best practices wise, if you're a contractor and you kind of know the things you generally need to be keeping track of, are there new things that you would say that you're finding from applying the provisions that are really best practices in tracking to be able to help with some of this analysis?
I don't know if TCJA really changed that. I mean, you always wanted to be in a position to be able to document your deductions, substantiate your deductions. So, generally speaking, best practice is the more substantiation and documentation you have for the business purpose of the expense, especially, you get into meals and entertainment and you have a shareholder meeting in Las Vegas. The more documentation you have that it's a legitimate business purpose for being out there, getting away from families, you have an agenda, a detailed agenda that you can bring up. The more likely these deductions are going to be sustained if the IRS is going to take a look at it. I don't know what you've seen, Damien, but I don't think TCJA in and of itself is causing me to say that you need to retain more or less documentation. I just always think when you're under IRS examination, best practice, you're more likely to do better the more documentation you have regarding expenses that you're claiming.
I would agree with you. I think perhaps maybe it's amplified existing requirements, and maybe you'd say in the past, oh, I kind of lumped everything together, like with the meals and entertainment, right? I lumped them together, and I didn't really do a great job of breaking out some of the potentially 100% deductible items before. Well, now it's a little bit more meaningful if you're talking about going from 100 to 0, I guess. But yeah, no, I think it's a lot of the existing stuff, just really making sure that you're actually doing that stuff, and it's kind of up the ante a little bit. I think in a lot of ways, and in a beneficial way, right? I think in most cases that you're able to get a better result if you go the extra mile, so to speak, to doing what's required under the law to substantiate those deductions. No, that's yeah, I think that's well put how you said it.
Mr. Grosh and Mr. Martin, don't forget about the new contemporaneous record-keeping requirements under the rental real estate safe harbor for the new 20% of qualified business income deduction, which includes hours of all service performed, description of all services performed, dates on which the services were performed, and who performed the services. Learn more with BKD's January 31, 2019 webinar on the qualified business income deduction, which you can find a link to in the show notes to this episode. Back to you, Mr. Martin.
Oh, we've kind of covered a lot of area already, but I don't know, is there anything that we haven't talked about so far that maybe you'd throw into the conversation?
Got to touch base a little bit on these enhanced depreciation deductions because that's been a big deal for contractors. So a new tax law expands both the bonus depreciation and Section 179 expensing limitations. So for bonus depreciation, the eligible bonus percentage increased to 100% for qualified property placed in service after September 27, 2017, and before December 31st, 2022. And it phases down 80, 60, 40, and 20% for property placed in service from 2023 through 2026, respectively. So, a significant increase in bonus depreciation. It's in play for a while. It also expands the definition of qualified property by removing the requirement that the original use must begin with the taxpayer. So, used property now qualifies for the deduction. So that helps to eliminate some of that documentation we always used to need to get in the past regarding whether, fixed asset additions were new or used. That's a big change. And with this enhanced Section 179 expensing, providing for $1 million of assets to be expensed under Section 179, with that phase out amount of $2.5 million. It's nice. That's permanent. The significance of this is that it's, we have 100% bonus depreciation for now, but those provisions expire. The Section 179 election provision is a permanent provision. They also expanded the definition of the qualified property that qualifies for 179 to include certain improvements to non-residential real property like roofs, HVAC systems, fire protection, alarm and security systems now all qualify for Section 179 expensing as well. And this isn't, I have to touch base on this because I've just seen some huge tax benefits for some of our, especially specialty contractors. The credits and incentives, R&D credit, more so work opportunity credit as well. There can be, some base hits with that. R&D credit can be a home run. Specialty subcontractors very happy that this credit was explicitly retained. We've seen specialty contractors claim hundreds of thousands of dollars of federal and state R&D credits. So the retention of the R&D credit was definitely good news for them.
Class, you can learn more about the R&D tax credit in episode 44 of the podcast with Ashley Thompson.
So taxpayers may have chosen a reduced R&D credit in the past to preserve a higher deduction of related R&D expenses. Given the new lower tax rates, it may now be more beneficial to forego the reduced credit election and claim a higher credit while reducing deductions. The credit is a dollar for dollar benefit that will offset tax liability at a lower rate. And the more beneficial AMT rules that we've been talking about will result in fewer taxpayers being subject to AMT, and therefore will be more likely to utilize the R&D credits passing through to them from their businesses. And as net operating losses are now limited to 80%, taxpayers may find R&D credits more beneficial to offset tax liability. And one change with the R&D credits is currently amortization of certain R&D expenditures over a 5-year period will be required for tax years beginning after December 31st, 2021. Efforts are being made to eliminate this requirement before it kicks in. Something to be cognizant of, especially a specialty subcontractor hasn't looked into the R&D credit. They could be missing out on a very lucrative opportunity. So we wanted to touch base on that as well. And Damien, I don't know what you've been seeing in terms of entity structuring, given the dramatic reduction to C corporation income tax rates. We've seen a little bit, I think you need to do the work. You have reduced individual income tax rates and the new 20% pass-through deduction. So I think you need to consider the benefits of switching the form of entity to determine if there's a more beneficial structure to do business in, including ESOPs. But generally speaking, for RS corporation contractors that are eligible for the 20% pass-through deduction, and they're not accumulating cash or anticipating selling the business in the relatively near future, we haven't seen much benefit or interest in switching from an S corporation to a C corporation, but each situation is different. So I think you, at the very least, need to do a high-level analysis to see if it makes sense to examine further.
It's a must in my mind to at least kick the tires and entertain it. And to really do that, obviously, it's a little bit more than kicking the tires. You've got to get in there and look under the hood and really give it a look. But it's something to be considered. But by and large, I'd say a lot of those that I've been working with and talking to and hearing from, haven't really been making a change per se, by changing their status. But a lot of them are definitely doing the analysis, giving it some thought, and maybe taking a wait and see approach to kind of see how some of these other factors align, really. So I'd say your experience is what I've been seeing and hearing as well.
So much that changed, so much that you need to be looking at. And, that might be the most reasonable approach. Wait and see how, when we finally start getting all of the forms out and the guidance out from the IRS to see, will it make sense? Maybe if it does, maybe we'll wait and do it next year. But something that you always want to be thinking about.
Well, that's it for today. But join us next time for the conclusion of our Back to Tax Reform series with a discussion on applying the TCJA provisions for financial institutions. Before you go, I'd really appreciate it if you'd leave us a rating and review out on Apple Podcasts. They go a long way in helping others ace the Simply Tax School by finding the podcast. Show notes to today's episode, which include more about our guest today, are available at bkd.com/simplytax. You can find me out on Twitter at Damien Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn.
I'm Professor Damien Martin. Thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.